Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, from foundational concepts to the sophisticated strategies investors use to grow their wealth with confidence. I'm Dear Chum, head of investor relations here at Focus Capital.
I'm Chad Schiller, founder of Focus Capital.
Chad, so we've spent the last several episodes building a comprehensive framework on how real estate deals work. Due diligence, capital stacks, pro formas, fee structures, asset classes. Had discussions with you, had discussions with the other Chad. Today we're going to zoom out to a question that ties that all together. Why do so many experienced investors keep coming back to multifamily? And why does it continue to be a compelling asset class in today's market specifically? So, full disclosure, this isn't a pitch for multifamily. It's an honest look at why the fundamentals of the asset class have historically held up, and what the current environment looks like, and what investors should be thinking about when they consider as part of a broader portfolio. So, first question, what makes multifamily fundamentally different from other classes? What is it about this asset class that makes it attractive at a foundational level?
I would say just a few main things for me, which is kind of what led me to multifamily in the very beginning, which we can cover later on, was it's a place where people live, and that won't go away anywhere anytime soon. So you're housing people. We have a shortage of homes to be built. We have population increasing. We have new starts decreasing. And the way these properties are valued on a cap rate basis make it much more attractive than other, let's call it single-family homes that are valued on more of a comp-based valuation. So there's more to it than that, how they can be operated and how they can be scaled. But fundamentally, I think it's really you have the supply demand imbalance. You've got the population increase. You've got need a place to live. You can't be replaced by much in terms of like housing.
Yeah, I would say that there's two roads of thought here. The one that you had mentioned first and foremost is people need places to live, unlike office, retail, or hospitality, which are sensitive to business cycles, consumer behavior shifts, and
Self-discretionary.
And I would say we saw a lot with the remote work trends, especially office space, like residential demand is needs-based. It's also, there's a few structural characteristics I would say that set multifamily apart. Diversified income, so 100 unit property has 100 income streams, losing one tenant, and that vacancy of 1%. We talked about in our last episode that having some vacancy isn't a bad thing. It's actually indicative that you're right where you need to be with your rents. Losing one tenant in a single tenant net lease building is 100% impact. What you had saying the difference between multifamily and single family homes. So if I lose 5 tenants in a 100 unit building, I'm still at a really good occupancy rate. I'm actually right where I need to be. If I lose my one tenant in my single family home, I'm going to be in a hard place. So diversification creates some stability is what I'm trying to get to on there. Where in most asset classes can't match that diversity.
Yep.
Short-term leases, short-term leases and annual leases can mean that rents reset to market faster than long-term commercial leases. In inflationary environments, I feel like that's a meaningful advantage. So even if you have an office space that is occupied all the time, those are usually multi-year leases that you can't pivot at the market's rate.
Yeah, and there's trade-offs, right?
Yeah.
I mean, we have the advantage by having usually 12-month leases with our tenants where we can cycle them out if they want to go somewhere else, renewal increases, new increase for new tenants and me leasing it, right? But it's also more management intensive, like our last episodes, right? Or versus a commercial office building, it's 5-year lease. It's pretty much hands-off, honestly.
Yeah.
Right? But there's trade-offs there.
What does the demand picture for this asset look like today? What is driving multifamily demand in today's market?
Driving demand, it's the supply and demand mostly.
I would say that there's a couple of things here. First, the home ownership gap. With mortgage rates elevated in home price.
Sorry, I misunderstood you there. Yes.
Yeah.
That's the main one.
With mortgage rates elevated and home prices still high in most markets, not in all markets, home ownership still remains out of reach for a significant portion of the population. Many households would historically have transitioned from renting to owning are now still staying in a rental market longer, and in many cases even indefinitely, which from a multifamily operational side is a positive net benefit for us. I also think of the demographic tailwinds. So millennials, I can speak to. I'm a millennial. The largest generational cohort in U.S. history to date are in peak rental years.
Like age 34 or 31, I saw recently.
Yeah, and many delayed household formation is due to like student debt and economic conditions. So that cohort is now forming households and is driving demand for quality rental housing in urban and suburban markets. And so the idea of the American dream, or we do business in the United States, is the house, the white picket fence, the two kids, the dogs, like that picture has changed so much over the last couple of years. I know some of the most successful people I know have apartments in multiple cities. They don't own homes anymore. Owning a home is now no longer indicative of success or making it anymore. And so I think that has another reason of why the multifamily market demand is continuing to expand. And then I also would say, like you were saying before, supply constraints. While newer construction has elevated in certain markets, I think that permitting and development pipelines have slowed materially. I think the other Chad and I were talking about this. It slowed in many areas due to rising construction costs, tighter lending standards for construction loans, and longer entitlement timelines. So constrained supply in the face of durable demand is favorable. Is a favorable fundamental backdrop for people investing in multifamily.
Yeah, and going back to what you said a few minutes ago, like the cost to own versus cost to rent has never had a bigger gap than before in history as it is today.
Yeah,
I saw a chart like earlier this year. It is mind blowing how much of a gap there is now. I think it's over double the cost of ownership versus cost to rent. And like you said, another great reason is most people are getting older and older now before they ever buy their first home. And some can't ever buy their first home because of how much it costs. So they're forced to be renters. And some may say we're going to becoming a renter nation here, which I see that happening. From the white picket fence, the two kids and the dog and the home for 30 years. Now it's more like let's rent a condo and have avocado toast and a puppy, right?
Yeah, but also because I think priorities have shifted. A lot of people in my generation like value flexibility and are willing to pay the premium. That is, and yeah,
transient.
Even if the gap between the cost to own and the cost to rent wasn't as big of a disparity as it is right now, which is definitely a big player. The ability, unless you have a family and kids or you're caring for someone that you need that type of, concrete stability, having flexibility for most people in my generation is valued at higher than putting equity into a home. Being able to sign a 12 to 18 month, lease is much more comforting to most people because the job market is also not what it used to be. Before, it was admirable to stay at somewhere for 10 plus years and grow a big tenure. But now it's like, it's a jobber's market. There are so many places that are looking to hire. And if you're at somewhere for longer than 2 years, it's no longer a red flag to be under that. It's like, okay, you're onward and upward, and which could come with relocation, which could come with remote work. So it's like, I could work for a company in Indiana while living in Denver, and because I want to do mountain biking and skiing and stuff like that. But then also, if I ever have to relocate to Indiana, I don't want to be stuck with my, 30 plus year mortgage, et cetera, for a house that I don't, really need at this point. So I think that all of those lifestyle changes in, addition to the cost disparity and the cost to own kind of have accelerated that market.
Yeah.
We've talked about all the positive things on why multifamily is a great asset class to invest in, but there are definitely risks associated. So what are some of the legitimate risks in multifamily right now?
The risks are, okay, people that maybe have a loss in wages or lose their jobs, or the cost of living has went up so much, which is going to put a ceiling on some of the rents you can charge. And the rents haven't risen with the cost of expenses rising as well, like insurance and taxes. That's one of the concerns right now with our properties or across the nation, right? It's just the rising cost of expenses and inflation and wages not meeting that.
Yeah, so rent growth moderation, big one. I would also say from an investor perspective, interest rate sensitivity. Deals are acquired or refinanced at low rates that are now facing refinancing at higher rates under real stress in some of these cases. Floating rate debt, without adequate rate caps has also been a source of distress in the market.
Yep.
I would say two other risks would be market selection. So that market selection matters more than ever. Broad multifamily exposure is not the same as thoughtful multifamily investing. Yep. And then markets with significant new supply pipeline. So look for markets with supply constraint, because when there's less competitors in the area, obviously and especially in an area where people need to rent, you're able to kind of maintain those higher rents.
I love those areas, actually. The areas to where you're the only show in town. There's nothing new coming up, nothing you've been built the last 5 years, 10 years. Like, that is a great market to be in. We bought a deal there a couple of years ago, and it's just been great to be in an area to where you don't have any supply coming in.
Yeah. Here is something that is not necessarily a tailwind. So headwinds and tailwinds, it risks and benefits. How does multifamily perform through economic cycles? I would say one of the arguments for multifamily is resilience. What does the historical record actually show?
It's a great question, Jared. Not sure on that data, actually. Overall, like I said, it's very, very resilient.
Yeah.
To put a number to it, I'm not sure how you would quantify that, but overall, when you're in a downturn, okay, you batten the hatches, you keep it occupied, you minimize vacancies, minimize turnover, you keep expenses moderate where they at. When you have an upswing, you push the rents, push the revenue.
Yeah. So multifamily, like you were saying, has historically demonstrated lower volatility and faster recovery than most commercial real estate asset classes, especially during economic downturns. So
compared to other assets, yes.
Yes. And let's talk about the 2008 financial crisis. That's a go-to one. It's super illustrated. Well, office, retail, hospitality experienced like severe and prolonged distress. Multifamily recovered relatively quickly because the underlying demand for housing, like you said, people need places to live.
Still there.
That it didn't disappear. Vacancy ticked up and rent softened definitely, but the asset remained fundamentally operational. One important caveat to that is past resilience doesn't always guarantee future performance. And we said that past performance doesn't guarantee future performance. And the specific deals, markets, and capital structure matter enormously. So multifamily held up well as an asset class in 2008, but individual deals with excessive leverage or weak markets or poor management did not. So it's while the market as a whole, while the asset as a whole is very resilient and can bounce back and recover quickly for economic downturns, you still have to manage that individual investment and make sure that you're not over leveraged on something.
Yeah, no, I agree. I mean, it could even compare like retail real estate, retail strip centers. Like, a lot could make businesses go out of business. E-commerce, okay, introduction of AI could put people out of business. But when you have a house or an apartment, where will people go live? They have to live somewhere.
And like we said earlier, it doesn't mean that there's no downturn. I mean, vacancy goes up and rent soften. But like you said, the demand for housing doesn't change. There's still the same amount of people. Yeah. It's just the ability to afford certain levels of rent will definitely change in an economic downturn, and you just have to be prepared for that.
Yeah.
Why do experienced investors often gravitate towards multifamily specifically for passive investing? So we've talked about investing overall. And one of the things that we had talked about in a previous episode is single family homes are most likely an active investment, even if you have, a property manager and stuff like that. So for the passive investor specifically, why does multifamily tend to be a natural fit?
It's just more work. I feel like it's more work to manage those assets than it is to manage industrial park or retail strip center. It's just more work, more labor intensive.
Mm-hmm. And because it's more labor intensive, there are more operators out there that's all they do. And so I mean, you can definitely actively manage as a single investor if you have the capital a multifamily unit. But when you're at the scale that we're at, where we're looking between, 150 to 200 units, that is not manageable by one person unless it's their full-time job and they have a team behind them.
Yep.
I would say that another thing is institutional validation. Multifamily consistently attracts the largest share of institutional capital in commercial real estate, which provides liquidity, comps, and a buyer pool exit that many other asset classes don't have. How does Focus Capital think about multifamily within its own investment strategy? Obviously, our entire portfolio is multifamily, but how do we think about it as a whole asset class when we are adjusting our portfolio?
Relative to other asset classes out there in real estate, yeah, like I said before, like there's more demand for it with people needing homes to live and places to live, and there's a lot less things that could impact that than looking at self-storage and land and office and medical and the whole 9 yards, right? I feel like that has got more fundamentals behind it as a cause to invest, a more stable investment that will grow over time, that people can get behind and believe in the thesis behind than other strategies. Now, not to say other asset classes in real estate can definitely make a lot of money in. You definitely can. You can just pick your poison, pick your lane, just go focus on one thing and just go do that really, really well, right? We happen to choose multifamily for that reason. Like that's what we're going to do really, really well. A lot of demand there, a lot of cause to create a lot of value here for people and by communities.
Yeah, I'm going to throw a quick curveball. Is there ever a scenario where it's actually a good strategy to acquire a property that does have some of that first floor commercial space and all the other apartment high rise? Like where is the benefit or lack thereof there when it comes to that balance between commercial and multifamily?
Well, I mean, it could be a home run, back to your curveball note there, but I mean, we've done it before. We bought mixed use before. If you're in an area that does have a need for retail or commercial office, like our deal here in Fishers, that can do really well. You got to find the right tenants though, and make sure they're the right ones long term. So I'm not opposed to that. We're very open to those properties. Now I want to have probably a very low percentage of the overall square footage be for commercial or retail tenants, right? Because that does increase the cap rate, which is a negative valuation factor, right, on those commercial office spaces. Whereas multifamily is valued much higher on a cap rate basis than those.
I kind of want to take the Focus Capital lens off for one more second. Before you started Focus Capital, you had got into passive investing into multifamily. We talked a little bit about your journey in episode 0 and a little bit in episode 1, but what other asset classes did you look at and what ultimately came down to deciding to do multifamily?
Honestly, I looked at single family homes, then duplexes, and then quadplexes and bought one of those. I never looked at seriously self-storage or land or commercial or medical, none of those. It was all just really homes and multifamily. I'm the kind of person where I pick my thing and focus on it and do 110% and just do it well and just go run, right? Blinders on, let's do the best we can, be the best in the space. But maybe I should have, right? But no, I'm glad we're at today. This has been great so far.
What was that deciding factor, though? I mean, you said that you look at single family, the duplexes and quadplexes, and you ultimately made the decision to do the quadplex. And obviously, you expanded from there into, you've been an active investor in over 600 units. But before that, before you even started looking, was it just when you were like, I know that the space I want to look at is real estate, or was it before that? Like before you even looked into single family homes, like where were you looking before or even thinking about? Maybe you didn't look into them, but you're like, hey, I have somewhere I need to put my capital in for tax liability or for capital preservation. Here are the 3 categories, I'm looking at, and then why real estate and then why multifamily?
It wasn't really even where to put capital on. That wasn't the focus originally, Jared. It was more of a how can I find a tax play to shelter income that I received from other business that I held for a number of years. And read Rich Dad Poor Dad, read some multifamily books, I think by Brandon Turner, watched Bigger Pockets and Grant Cardone. And just, I knew that buying real estate that was residential was where I wanted to get into, because everything I read was like, okay, the cash flow, the covers the expenses, they pay the loan down, the equity increase, the depreciation, all kind of made sense to me.
Yeah.
But it was probably the first 2 years at going to tour these single-family homes at the market. I'm either I couldn't get the numbers to work out right, or I was just like too conservative.
Yeah.
Like very scared to make a mistake the first deal, that's probably what it was actually. But it was natural evolution of like, look at all these homes that didn't work out for me. Okay, let's go to duplexes. Let's get 2 doors and see if we can make that work with the capital I've got and do one of those. And those didn't work either. And triplexes, not much of those here in the city. And then it was quadplex. And then then I learned, well, quadplexes, fourplexes and above are valued on cap rates, not on area comps. I'm like, aha, so if I find a fourplex that I can increase the value, I can actually increase the value pretty substantially in the first year, whereas with a single-family home, I can't do that. So that's when I was like, all right, 4 years and above is the matching number here. And I think it was within about 6 months after touring my first 4 unit that I bought that one. That's where it started.
Yeah, I think that the biggest key driver there was you knew that you were looking for a tax liability play, which already eliminates certain investments, because even though you might get cash flow and it might be a relatively stable investment, real estate offers certain tax advantages that no other type of investment offer. So, and so it automatically, organically eliminated where your thought process was going. I think the last thing that I'd say is that we do only multifamily. We do a couple of mixed unit properties, but all these positives, multifamily isn't a guaranteed winner, but no asset class is. A combination of needs-based demand, income diversification, operational maturity, in alignment with structural demographic trends makes it a place where disciplined investors have historically found durable risk-adjusted returns, and where the fundamentals today, understood clearly and honestly, continue to make a compelling case for multifamily as an asset class.
Yep.
Anything else you want to add on Mand?
No, you covered it all. And back to your point a minute ago was really any one certain asset class is not a for sure win that will go very, very well. It all comes down to execution too.
Yeah.
That's where it's all going to be. That's the bottom line.
Yeah. And that's why for passive investors, again, we harp on this every episode, but really evaluating your operators is where it's at, because that's the fundamental base of how that asset is going to perform.
Yeah, I agree.
Perfect. All right. See you next week.
Next week.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.